Whenever there is a problem on amalgamation or merger, all the assets should be transferred to realization account debit side, whether they're taken over or not. You are transferring all the assets and liabilities to the new company. So goodwill 2,70,000. So we are transferring the assets of both the companies. Whatever is the difference between the liabilities minus assets. If liabilities is more, then it will appear as the general reserve as 1,37,100. Hello everyone, I am Purnima, faculty in the Department of Commerce and Management, Vidhyaashram First Grade College Temple of Excellence, MYSURU. I welcome you all to this session. In this session 9 of Unit 2, we will be working out some more problems on mergers and acquisitions. Now, let us see what is the problem all about. Now, the balance sheet of P Limited and R Limited as on 31/3/2020 was as under. So, they have given us the balance sheet of two companies, that is P Limited and R Limited. So, the share capital, preference shares of rupees 10 each, 5 lakhs. So, there are no preference shares in R Limited. Then, equity shares of rupees 10 each, 15 lakhs. And in R Limited, we have 5 lakhs. General reserve 8 lakhs in P Limited. There is nil balance in R Limited. Profit and loss account 9 lakhs. In R Limited, it is 3,20,000. Creditors 50,000. In R Limited, it is 20,000. The total liabilities of P Limited is 37,50,000 and the total of R Limited is 8,40,000. Now, on the asset side, we have goodwill. So, goodwill of P Limited is 2 lakhs, R Limited is 70,000. Fixed assets 30,50,000. R Limited it is 2,50,000. Then investments, so 1,80,000, 25,000. Stock 2 lakhs, 2,70,000. Debtors 80,000, 1,65,000. Cash at bank 40,000, 60,000. Total 37,50,000, 8,40,000. Now, we are given the balance sheet of P Limited and R Limited. Let us see what is about the additional information here. A new company, PR Limited, was formed to acquire the assets and liabilities of P Limited and R Limited. Now, there is a new company called PR Limited. So, PR Limited is the new company. Now, this is buying both the P Limited and R Limited. So, it is purchasing P Limited and R Limited. Now, the terms and acquisition was as under. So, how it is purchasing? Let us see here. PR Limited to have an authorized capital of 90 lakhs divided into rupees 8,000 equity shares of 10 each and 10,000 14% preference shares of rupees 100 each. Now, they have an authorized capital of 90 lakhs. Now, the PR Limited is the new company which is being formed. It has a capital of 90 lakhs which is divided into 8 lakhs worth equity shares and 1 lakh worth of preference shares. Then, business of P Limited was valued at 40 lakhs and settlement was made by the issue of equity shares. Now, this PR Limited, they are paying whom? P Limited. How much they are paying? 40 lakhs. So, the business was valued at 40 lakhs and they are paying it in the form of equity shares. So, they are paying equity shares to shareholders of P Limited. Then, next one, the business of R Limited was valued at 10 lakhs to be satisfied by the issue of equity shares. Now, this PR Limited company, they are paying 10 lakhs to the shareholders of R Limited. PR Limited made a public issue of rupees 6,000 14% preference shares of rupees 100 each at par and 1 lakh equity shares of rupees 10 each. So, in addition to all this, they have also made public issue. Then, the cost of formation of PR Limited amounted to 56,000. So the realization expenses. So what are the formation expenses? So what we call as the preliminary expenses, it came up to 56,000. The cost of liquidation of P Limited amounted to 10,500 and R Limited 5,400, and the same was paid by PR Limited. Now this refers to the realization expenses. So the realization expenses, it is being borne by the purchasing company. So the realization expenses for P Limited, it is 10,500 and R Limited, it is 5,400. So it was paid by PR Limited. So the selling company is not paying the realization expenses. So purchasing company is paying the realization expenses. So the entry should be made in the books of the purchasing company and not in the books of the selling company. So we should remember that if the realization expenses are borne by the selling company, then we have to mention that entry in the realization account. But if the selling company is not bearing the expenses, then we need not mention about the expenses in the realization account. Give journal entries in the books of P Limited, R Limited and PR Limited and prepare the balance sheet of PR Limited. Now we are supposed to prepare the journal entries of P Limited, R Limited and PR Limited and prepare the balance sheet of PR Limited. Now, see, whenever we are given a problem of this, so first thing is we have to transfer all the assets to realization account, whether they are taken over or not. So all the assets, they go to realization account. So only if cash is taken over, it should be transferred. If they mention cash is not taken over, don't take cash. But otherwise, whether they are taken over or not, we have to transfer all the assets to realization account debit side. The same way, the liabilities. Here we should understand that liabilities are liabilities to outsiders. So this also, if it is taken over only, we take it to the realization account. If it is not taken over, don't take it to the realization account. So this creditors goes to the realization account. So the rest of the accounts, whatever are there in the balance sheet, they go to the shareholders account. So this you should understand. So whenever there is a problem on amalgamation or merger, all the assets should be transferred to realization account debit side, whether they're taken over or not. Then all liabilities will go to the credit side of realization account only if it is taken over. Then all the rest of the reserves and capitals, they go to the shareholders account. So in this way, we will be closing the books of accounts. Now, the next step will be, we have to prepare the journal entries in the books of P Limited. So we are transferring all the assets to the realization account debit side. So I write goodwill account, fixed assets account, investments account, stock account, debtors account and cash account. So all this goes to the realization account. So when we total up all this, we get 37,50,000 being transfer of assets to realization account. Now, the next entry will be for the transfer of liabilities taken over. See, whenever it is mentioned in the problem that the business is purchased by so and so, it means that the entire assets and liabilities are taken over by the new company. So there should not be any doubt whether some of the assets or liabilities are not taken. So everything is taken. Now we have only one liability here. So creditors account debtor 50,000 to realization 50,000 being liabilities transferred to realization account. Now if I write realization account here, so on the debit side all assets, what is the total of assets value? 37,50,000. Now the liabilities value is 50,000 and then we have the purchase consideration purchase consideration is 40 lakhs as we had seen now. So the PR Limited debtor 40 lakhs to realization account 40 lakhs. So being purchase consideration due. Now whatever is the difference, so that will be transferred to the shareholders account. Now equity shares in PR Limited account debtor to PR Limited account being receipt of purchase consideration. See how they are paying the purchase consideration. Purchase consideration is being paid in the form of equity shares in PR Limited. So I debit them. Equity shares in PR Limited account debtor to PR Limited account 40 lakhs. Then the next entry will be, we will be transferring the preference share capital to the shareholders account. Preference share capital account debtor 5 lakhs to preference shareholders account 5 lakhs being amount due to preference shareholders. So the share capital is to be paid, is to be returned to the shareholders. So I am writing preference share capital account debtor to preference shareholders account. Then next, these preference shareholders, they are being paid shares in the PR Limited. So they are the receivers. Preference shareholders account debtor 5 lakhs to equity shares in PR Limited account 5 lakhs. So the preference shareholders, they are being allotted the equity shares in the new company. So this entry is, they are the receivers of the shares. So I am debiting the preference shareholders account and crediting equity shares in PR Limited account being allotment of equity shares to preference shareholders. Then the next entry will be the realization account debtor 3 lakhs to equity shareholders account 3 lakhs being profits transferred to shareholders account. So when we do the realization account, so I write here realization account. On the debit side we have 37 lakhs 50,000. On the credit side we have liabilities worth 50,000, and then we have the purchase consideration due 40 lakhs. So total will be 40 lakhs 50,000. Here also it will be 40 lakhs 50,000. The difference of 3 lakhs, that is the profit on realization, that should be transferred to equity shareholders account. So realization account 3 lakhs to equity shareholders account 3 lakhs being profit transferred to equity shareholders account. Then the next is the equity shareholders, they are entitled to get back the capital and all the reserves of the company. So equity share capital account debtor 15 lakhs, general reserve account debtor 8 lakhs, profit and loss account debtor 9 lakhs, to equity shareholders account 32 lakhs being transfer of balances to equity shareholders account. So whatever is the rest of the funds and the capital remaining in the balance sheet, they are being transferred to equity shareholders account. Then next is the equity shareholders account debtor 35 lakhs. See, out of the 40 lakhs equity shares, out of that 5 lakhs are being paid to the preference shareholders. The remaining 35 lakhs, it is being paid to the equity shareholders. So, equity shareholders account debtor 35 lakhs to equity shares in PR Limited 35 lakhs being payment made to equity shareholders. So, in this way, we have transferred all the accounts in the balance sheet to the we have closed all the accounts. Now, in the books of R Limited, now this is one more company, second company. The first company is P Limited. So we have closed all the books of accounts of P Limited, transferred all the funds to the respective shareholders account. The same way in the books of R Limited also, we have to prepare the realization account. So the realization account debtor to that is 8,40,000, to goodwill, to fixed assets, to investments, to stock, to debtors and to cash. So all this we have transferred all the assets to debit side of realization account. So being transfer of assets to realization account. So we have transferred all the assets to the realization account. Next, The creditors. Now, what is the value of creditors in R Limited? It is 20,000. So, creditors account debtor to realization account 20,000 being liabilities transferred to realization account. So, whatever are the liabilities, you transfer them to realization account. Then, next one is PR Limited account debtor 10 lakhs to realization account 10 lakhs. See, 10 lakhs is the purchase consideration which has been fixed for the R Limited company. So that entry is PR Limited account debtor to realization account 10 lakhs being purchase consideration due. Then this purchase consideration is paid in the form of equity shares in PR Limited. So equity shares in PR Limited account debtor 10 lakhs to PR Limited account 10 lakhs being receipt of purchase consideration. So this is purchase consideration received. So we are writing this entry. Then realization account debtor 1,80,000 to equity shareholders account 1,80,000 being profits transferred to shareholders account. So whatever is the balance of the profit, so that will be transferred to the shareholders account. Then next is we have to transfer the share capital and the reserves to the equity shareholders account. So equity share capital account debtor 5 lakhs, profit and loss account debtor 3,20,000 to equity shareholders 8,20,000. So the equity shareholders are entitled to receive the capital whatever they have invested. In addition to that, they are also entitled to receive the balance in profit and loss account. So what does it mean? The profit and loss account, if it is appearing on the liability side, it means the profits whatever of the company is earned. So that will be shown on the liability side of the balance sheet. So that profits are, the equity shareholders are entitled to that profit. So 3,20,000. So being transfer of balances to equity shareholders account. Then last entry will be for payment made to equity shareholders. So equity shareholders account debtor 10 lakhs to equity shares in PR Limited 10 lakhs being payment made to equity shareholders. So we are passing an entry for payment made. So who is receiving the shares? Equity shareholders are receiving the shares, and what they are receiving? Equity shares in PR Limited. So whatever equity shares they are receiving, so that we have to credit. So totally they are receiving 10 lakhs worth of equity shares in PR Limited. Then next, they have also asked us the journal entries in the books of PR Limited. So this is the books of the purchasing company. So this is the purchasing company's books, and we are doing problems on nature of merger. Nature of merger. Till now we were doing problems assuming that it is amalgamation in the nature of purchase. Now, whenever there is a nature of merger, there will be slight change in the journal entries. Please make a note of it when I am explaining here. Now, what will be the first entry? Business purchase account debtor 50 lakhs to liquidator of P Limited 40 lakhs to liquidator of Q Limited 10 lakhs being acquisition of business of P Limited and R Limited. Then next one will be you are transferring all the assets and liabilities to the new company. So goodwill 2,70,000. So we are transferring the assets of both the companies. We should add. So if you can see here in the balance sheet given, if you can see, goodwill is 2,70,000. So 2,70,000, that's what we have written here. In the books of the new company, when we are writing, it will be 2 lakhs plus 70,000, 2,70,000. Again, fixed assets it is 33 lakhs, investments 2,05,000, stock account 4,70,000, debtors 2,40,000, cash account 1 lakh. So to trade creditors 70,000, to business purchase 50 lakhs. So here it is 40 lakhs plus 10 lakhs, the total business purchase is 50 lakhs. Now, the difference between the liabilities and assets, that will be considered here. That will be the profit and loss account, 4,80,000 being assets and liabilities taken over. Then the next one will be goodwill account debtor to bank account being payment of cost of liquidation. So here the cost of liquidation or the realization expenses, it is being borne by the purchasing company itself. So we have to write the entry in the purchasing company's books. So whatever the realization expenses, that we call it as goodwill. So this refers to the realization expenses. We should understand that whatever the realization expenses, it is paid by the purchasing company, that will be considered as goodwill in the books of the purchasing company. So total expenses of both the companies, it comes up to 15,900. To bank account 15,900 being payment of cost of liquidation, or we also call it as the realization expenses. So the realization expenses will be called as goodwill, and we will pass an entry goodwill account debtor to bank account. Then next will be preliminary expenses. So the cost of formation of the new company. So this expenses is for formations for the new company to be formed. They are incurring an expenditure of 56,000. So preliminary expenses account debtor to bank account 56,000 being cost of formation of the new company. So in addition to goodwill, we have one more entry, that is preliminary expenses. So preliminary expenses account debtor to bank account 56,000. Then next one will be, they have also told us that the new company is issuing a preference share capital and equity share capital. So since they are issuing preference share capital and equity share capital, they will be receiving money from the public. So whatever money they are receiving, so we have to debit the bank account. Bank account debtor 16 lakhs, to preference share capital 6 lakhs, to equity share capital 10 lakhs. So they are issuing 6,000 preference shares. So 6,000 into 100 comes up to 6 lakhs, and equity share capital worth rupees 10 lakhs being public issues of shares. So they are issuing the shares. Then we have to pass the entry for payment to the liquidators of P Limited and R Limited. So the liquidator of P Limited, he is being paid 40 lakhs, and liquidator of R Limited is being paid 10 lakhs. So to equity share capital account 50 lakhs. Now who is the liquidator? Liquidator is the person who sells all the assets and pays off all the liabilities, and whatever is the balance, he will be sharing it with the shareholders. So this we should understand here. So the liquidator of P Limited is paid 40 lakhs, R Limited 10 lakhs, equity share capital is 50 lakhs. So this is being discharge of purchase consideration. So they have paid purchase consideration in the form of equity shares. Next, so here we should make a note. There is a note here. The cost of liquidation by the transferee company should be debited to general reserve account in the nature of merger. So if there is a general reserve account, we should debit the cost of liquidation. Since there is no credit in general reserve account, hence it is been debited to goodwill account. So if there is a general reserve, so you just reduce the balance of general reserve and you can make an entry. But here in this problem, there is no general reserve. So we are just debiting it to the goodwill account. So next one is the calculation of amount to be adjusted against the reserve. How do we adjust the amount to the reserve here? See, first thing is the equity share capital of P Limited. What is the equity share capital? 15 lakhs. Equity share capital of R Limited is also 5 lakhs. So preference share capital is 5 lakhs. Now, the total is, what is the total capital here? P Limited it is 20 lakhs, R Limited it is 5 lakhs. Now, from this we deduct the purchase consideration. What is the purchase consideration of P Limited? 40 lakhs. Purchase consideration of R Limited is 10 lakhs. So, from 40 lakhs you deduct 20 lakhs. So, there is a difference to be adjusted for 20 lakhs here, and here also there is a difference to be adjusted for 5 lakhs. Now, what is the general reserve? In P Limited, there is no general reserve. In R Limited, there is a general reserve of 8 lakhs. Now, the profit and loss account of P Limited and P&L account of P Limited and R Limited, it is 12 lakhs 20,000. So, when we just simplify this, so 12 lakhs 20 minus 8 lakhs, when we add this, totally we are getting 20 lakhs 20,000 less difference to be adjusted. So, the total difference to be adjusted is 25 lakhs. So, the debit balance in profit and loss account, it comes up to 4 lakhs 80,000. So, here the total profit and loss account of both P Limited and R Limited is 12 lakhs 20. You add the profit and loss account and general reserve, you add this both together. So, we get 20 lakhs 20,000. From this, you deduct this total difference. 20 lakhs plus 5 lakhs. From this, you deduct 25 lakhs. So, the balance, debit balance in P&L account is 4 lakhs 80,000. So, this is the amount to be adjusted against the reserve. Then, next, we have the balance sheet of the new company. So, the balance sheet of PR Limited after amalgamation. So, we will see what is the balance sheet here. So, the share capital, 6,000 preference shares of rupees 100 each, that is 6 lakhs. Then 6 lakhs equity shares of rupees 10 each, 60 lakhs. Then we have the creditors, 70,000. That's only we have here for the liability side. There are no other entries. The total comes up to 66 lakhs 70,000. Now, on the asset side, if you can see here, so we have the goodwill value 2,85,900. So, in the previous balance, what we had? 2,70,000, 2,70,000 plus 15,900. So, 15,900 is the realization expenses. Together, when we add, we get 2,85,900. Then the fixed assets, the same thing we write. We are adding the assets of P Limited and R Limited here. So, the investments also, both the investment of P Limited and R Limited, we are adding. Stock 2 lakhs plus 2 lakhs 70. So, it is 2 lakhs plus 2 lakhs 70. It comes up to 4 lakhs 70. Then debtors 2 lakh 45,000. Cash at bank. Then profit and loss account 4 lakhs 80,000. That is the debit balance of profit and loss account. Say preliminary expenses also comes on the asset side of the balance sheet, because this preliminary expenses is a deferred expenditure. So, if it is a deferred expenditure, every year you have to write off a small part of the preliminary expenses. So, it will be shown on the asset side of the balance sheet as it will be shown as an asset. It is a fictitious asset. And then, so we have the balance sheet of PR Limited. So, the total comes up to 66 lakhs 70,000. So, this is how we have to prepare the amalgamation in the nature of merger. So, whenever there is a problem of amalgamation in the nature of merger, so we have to follow this. So, there will be no changes in the books of the selling company, as the procedure will remain the same. But then in the books of the purchasing company, there will be a small adjustment which we have to make a note of when we are preparing the balance sheet and also the journal entries. Please make a note of it when we are working out the problem. So, we have one more problem here. On 31st, 3, Thin Limited was absorbed by Thick Limited. It takes over the assets at book values. The consideration was fixed at 4 lakhs. to be discharged in the form of fully paid equity shares of rupees 10 each. The balance sheet of the two companies stood as under. So we have the balances 9 lakhs, 2 lakhs, general reserve, profit and loss account, workman compensation fund, creditors, goodwill, plant and machinery, stock, debtors, and staff provident fund, provision for tax, prepaid insurance, cash in hand, cash at bank, etc. See, whenever we are given a problem, transfer all the assets to realization account debit side, then transfer all the liabilities which are taken over only to realization account credit side, then or transfer all the balances to the shareholders account. So the amalgamation expenses amounting to 1,000 paid by TIC Limited. You are required to show necessary ledger accounts in the books of TIN Limited, journal entries in the books of TIC Limited, and the balance sheet after amalgamation. So we have the realization in the book account in the books of TIN Limited. So we have the goodwill, plant and machinery, furniture, to stock, to debtors, see, to prepaid insurance, to income tax refund, cash in hand, cash at bank. So all the assets, whether it is fictitious or not, everything will be transferred in the nature of merger. Nature of merger, this is. So we'll transfer as it is. Then creditors, staff provident fund, provision for tax, purchase price. So 4,39,000. So there is a profit of 1,28,100. Then next, TIC Limited account debtor to realization 4 lakhs. So they are paid in the form of shares. So buy equity shares in TIC Limited 4 lakhs. Now equity shares in TIC Limited to TIC Limited account 4 lakhs, buy equity shareholders account 4 lakhs. Then next we have the equity shareholders account. So buy equity share capital 2 lakhs, general reserve 50,000, profit and loss account, workman compensation fund, buy realization account 4 lakhs, 2 equity shares in TIC Limited 4 lakhs. So I have transferred all the balances to the equity shareholders account. Now next we have the journal entries in the books of TIC Limited. So what will be the journal entry? Business purchase account debtor to liquidator of TIC Limited. So business purchase, they are paying 4 lakhs to a liquidator of TIN Limited 4 lakhs, being acquisition of business. Now the liquidator is paying 4 lakhs. How he is being paid 4 lakhs? In the form of equity shares. Then next we transfer all the assets. So goodwill, plant and machinery, furniture, stock, debtors, then prepaid insurance, income tax refund, cash in hand, cash at bank, to workman compensation fund, to staff provident fund, to provision for taxation, to business purchase account. So whatever is the difference between the liabilities minus assets, if liabilities is more, then it will appear as the general reserve as 1,37,100. So being incorporation of assets and liabilities. Suppose here the liability side is more, so whatever is the difference, it will come as the general reserve and the debit side. Then next one will be a general reserve account debtor 1,000 to bank account 1,000. So this 1,000, it is nothing but the realization expenses which are being paid. So the realization expenses that we will be writing as general reserve account debtor to bank account. Then the next one, we have the balance sheet here. So 1,30,000 equity shares of rupees 10 each, 13 lakhs, general reserve, profit and loss account, creditors, staff provident fund, provision for taxation, workman compensation fund. So as it is, we write everything. So the same way, the goodwill, machinery, furniture, stock, debtors, prepaid insurance, income tax refund, cash in hand, everything. So it comes up to 15,03,925. So in this way, we have merged the balance sheet of TIC Limited and TIN Limited. So here the new company which is taking over is the TIC Limited. So for that we have to add all the balances of TIN Limited and we get all these balances. So the calculation of amount to be adjusted against the reserve here. So what is the equity share capital of Thin Limited? It is 2 lakhs. So what is the purchase consideration paid? 4 lakhs. The difference to be adjusted is 2 lakhs. Now what is the general reserve of Thin Limited? 50,000. P&L account of Thin Limited is 12,900. Totally it comes up to 62,900. So when we adjust the difference, so this is the 2 lakhs to be adjusted. So when we adjust, we have a debit balance of 1,37,100. So the general reserve of TIC Limited is 1,80,000. So less debit balance of 1,37,100 plus 1,000. 1,38,100. So the whatever is the balance remaining, so that becomes the general reserve of TIC Limited, 41,900. So in this way, we have to adjust the amount against the general reserve. So with this, we come to the end of this session. Hope you have all followed it. Thank you.